Most people don't understand how the banking system actually works. Hence the reason why they continue to deposit money in it, because they think it's safe. Well, it is safe, but I want to show you exactly what the banks do with our money and how you can potentially start your own banking system by leveraging one of the strategies that banks use to actually make more money for themselves. Now, ideally, if you had money, your number one goal is to make sure that it's safe. So you put it into the bank because that's what we've been taught to do. So in this example, you have $50,000 and you deposit it in the bank, and they will gladly take the money and pay you roughly about 0.04%. Now, what I want you to understand is this. When we deposit money in the bank, it's a liability to the bank because it's not making them any money. It only becomes an asset when they take that money and issue it out as a loan to make themselves more money, right? And that's what we call fractional reserve banking. In other words, by law, they're legally able to take 90% of our deposit and issue it out as loan while only keeping 10% on the books. Okay. So what does that look like? So in this example, you can see that someone comes to the bank and say, you know what, I need a mortgage. So the bank would gladly issue out the mortgage loan because they have billions of dollars because, millions of people are making deposits. So when they issue out that mortgage, this homeowner is now paying the bank 7% interest on the mortgage that they issued out. But guess what? That is not the bank's money. That is our money collectively, right? But they're earning 7% but paying us 0.04%. Now, you also look at someone who needs a car loan, right? They come to the bank will gladly give them the car loan. But guess what? In return, you're paying somewhere around 9%, maybe lesser. But the whole idea is the banks are leveraging customers' money to create wealth for themselves. All right. That's part of the whole banking system. Then you also look at student loan, right? You got your education, you're excited, but guess what? You now have to pay back, pay back the bank, the loan that they issued you. So let's say 6.5%. All right. So you can see all the system is designed to help the banks get richer. All the while, it's our money that's being funneled into the system. All right. Now, the other thing I'm going to touch on is what we call BOLI. Now, a lot of people don't know this. BOLI stands for bank-owned life insurance. This is one of the safest places that banks put money into to grow their money without ever losing a dime. You don't have to believe me. Do your research. There are more than 3,000 banks in the United States that have money in bank-owned life insurance policies, right? And they're earning anywhere from 5 to 10% interest on that money. Now, here's what you need to understand. You can actually set up a similar system using life insurance policy to create your own banking system. All right. Now, here's how it works. Let's assume that this is a life insurance company. All right. And let me say this. The number one goal of life insurance is protection, meaning whatever you decide to do, it is going to come with cost of insurance. It's not free. All right. And number two, it is not an investment, but you understand how to use it to your own benefit in a second. So you have your life insurance company. You're paying for this policy every month. Now, let's assume that you still have this $50,000 and you don't want to keep it in traditional banking system, but you still want to leverage it. So you're able to take this $50,000 and put it inside your policy. Now, here's what happens when you put money into a life insurance policy. You're able to still get that 5 to 10% growth on the entire $50,000. Number two, that $50,000 is safe, meaning you will never ever lose a dime of that money because of the inbuilt protection in the policy. Now, here's where it gets more interesting. Let's assume that you decided that you wanted to purchase a home because you're a first-time home buyer. And now you have $50,000, but you need about $30,000 for down payment. Well, now you're able to now come into the policy and borrow against that $50,000. What does that mean? That means your $50,000 is still in the account, right? Untouched, but you're leveraging against it, meaning the insurance company will loan you $30,000 while you're still earning interest on your entire $50,000. It's called uninterrupted compound interest. So now you pay, you use this for down payment, but the beautiful part is this. You necessarily don't have to pay back the money. So what will happen is in the event that you don't pay it back, they simply deduct the loan from the death benefit whenever you pass away. But it's always beneficial, especially if you intend on making it your own banking system, to always pay it back into the policy so that in the future, you have more leverage to now do things like, maybe get a car for, car rental business or more real estate investment business or any other type of business that you want to do. And that's one of the strategies that the banks use to create their own banking system. So if you want to learn how to stop making the banks richer and you want to create your own banking system, click on the link below or reach out to us and we'll be able to show you exactly how you can create similar system to become your own bank.